Geoff, in this low rate and negative rate regime, there are some strategists out there who are saying that now is the time to underweight the S&P 500 in favour of gold. The two have been positively correlated since March. Would you agree with that, or would you say hold the S&P 500 and hold gold, or does it depend on whether you are glass half full or empty, as you were just referring to?
So if you are glass half full, I think in terms of asset allocation, equities will certainly be the best play over the medium to longer term. Equities, especially those with pricing power, they will react to investment. You will get margin expansion. You will get re-rating. Whereas gold, liquidity issues, and you have the more constrained breadth of investability. So yes, it can always be a hedge as part of asset allocation, even a tail hedge against inflation risk. But who said that equities can't hedge against inflation? Over the longer term, they probably are a much better play there. But again, if it's an aggregate demand story, then equities will have to react to that. Gold right now, it's pure inflation story. You can't really price in aggregate demand into gold, whereas in equities you can.
Right. On inflation then, Geoff, do we have much further to run to the upside on US inflation expectations? Because that, of course, does impact how much further the real yield can fall.
Sure, plenty. So looking at the five-year forward break even, that's probably the first chart we should all look at, when we turn on our Bloombergs every day. We're at 170 right now, much better compared to a few months ago, but plenty of ways to go. If you believe the Fed wants to overshoot inflation, then we're talking well above 250, that kind of range. Remember when Draghi said he was worried about European inflation expectations being de-anchored, the inflation talk was around 170, that kind of a level. So below that, it's de-anchoring. So 170 is your minimum to get an overshoot. Then we're talking at least 50 basis points higher.